Welcome to It's the Economy. The equity markets have recovered much of their losses post the exit poll, but the bond market has not. On Monday, the 10-year bond yield fell to a low of 6.94, a historic low actually, a multi-year low on the exit poll, indication of a resounding victory for the BJP. And on Tuesday, after the results, the yield rose 10 basis points to 7.04. Now, despite assurances that the Narendra Modi government, Narendra Modi and the NDA will form the government, the yield is stubbornly at 7.02, so not quite recovered. What are the bond market's worries? Can the Reserve Bank's monetary policy statement assuage the bond market's fears? Where are yields headed? For all this, we are joined by Abhishek Upadhyay, the senior economist at ICICI Securities primary dealer, and Suyash Choudhary, head of fixed income at Bandhan Mutual Fund. Gentlemen, thank you very much. I initially intended this as a, credit policy heads up, but now, the complications in the bond market are more interesting. So let's start over there. Abhishek, your thoughts. Why the worry? Why are we not seeing a recovery despite the fact that, the assurance of a reasonably stable government is there?
Well, Latha, so bond market clearly, in contrast to equity markets, is more worried about the uncertainty bands around the fiscal dynamics. In the run-up to the exit polls and election results, the market had been buffeted by two key favorable developments. One, of course, RBI dividend payout, which had been far larger than was priced in the budget and assumed by markets as well. It was assumed that the roughly 0.3%, a little higher fiscal largesse coming from that side could potentially be used for additional fiscal consolidation. That expectation had been boosted further by the provisional data, fiscal data that was released again end of the month, and which indicated fiscal deficit for last year was 0.25% of GDP less than was assumed in RE. So all these two factors together meant that the cash balance which government was running currently is almost 3.5 times the cash balance it was running same period last year, and that this could potentially be used to cut the GSEC borrowing program, which was assumed in the revised estimates. But now, with there being bigger uncertainty, I don't think markets are assuming a regime shift in fiscal policy. Still, the assumption is fiscal deficit will be around the same ballpark. But that expectation of a big borrowing cut that was likely to be announced otherwise, there is a wider uncertainty band around that expectation, and the market anxiety reflects those worries.
Okay. Now, fair point. We were flashing that as well. The expectation of a borrowing cut was very much, beginning to simmer. But Suyash, what is your estimate? Is there an expectation that the fiscal deficit will be higher than 5.1? Is that a fear at all? The more important, buzz I hear is about the MSP. Given the rural distress, which is now very obvious in the poll results, do you think MSP will be raised, and will that have impact on the bond market, or is it already getting discounted?
So, Latha, Abhishek summarized it well. I think the delta here is the expectation earlier that there would be a supply cut basis the excess dividend, which now market, I think, is veering around to the view that there'll be no bond supply cut. And the excess will get basically used to push up revenue spending. Beyond this, I would not hypothesize too much. See, part of the weakness is consumption demand. Will have to balance forward in a change in mix between revenue spending and capital spending. I would think the government's focus would have been generate enough forward multipliers by upfronting capex spending. But if you see, the year-on-year growth rates of revenue spending versus capital spending, probably over a period of time, that starts to turn a bit, which is absolutely fine from a macroeconomic stability standpoint as well. look at also, for example, the composition of core inflation, where or rather headline inflation, where core is at 3.2% and food is at 8.5, etc. So that also needs to rebalance somewhat going forward. Look at the composition of real GDP, where personal consumption is growing at 4% and capital formation at 9%. So there is rebalancing pending, and it would anyways happen. And I think it's partly unrealistic if one expects that revenue spending grows at the current pace and capex spending grows at the current pace. And we don't worry from a macroeconomic standpoint at all, because eventually the variable one has to track is current account deficit, which is basically the summary of net dis-saving at each of the public sector, private sector, and household level. And that is absolutely
those have not changed much for the market. Obviously, the near-term fear is probably higher fiscal spending, and definitely the hope going away that borrowing program will recede, will be cut in some fashion. Some 10, 20,000 crore, even that is now out of the window. But Abhishek, is there a bigger fear that we have to take into consideration? The Agricultural Department released some data showing that potato and several other products output is lower than estimated. Do you think that we should be prepared for something in June itself? I'm just coming to the monetary policy in a bit. Is there a likelihood, if the MSP is raised, is there anything that can impact inflation and therefore bond market immediately?
Well, so what we have seen over the last few years is that correlation between MSP hikes and food inflation for specific commodities, it has come down a bit, partly because market prices anyways have been higher than MSPs. So to that extent, it is less harmful. But yes, we need to see the exact nature of policy making on that front. It could have some bearing on food inflation dynamics, which RBI anyways is watching more closely. But my baseline assumption is that inflation dynamics remain very favorable. Underlying inflation, in fact, is settling down below 4%. I would say between 3.5% to 4%. Even food inflation, while it looks very high right now, is predominantly on account of very volatile items like vegetables, etc. Underlying food inflation, again, is around that 4% or slightly lower as per different metrics we track. So not very worried about inflation. And I do believe that even if you do get some surprise on MSPs, etc., that you're pointing out, our assumption was that inflation this year could well average below RBI's forecast, which is 4.5%. So there is some buffer there for inflation to go up, even to meet RBI forecast.
Oh, that's a very big relief, especially for equity market watchers who don't look at these things very closely. This fear goes out that food inflation could be a bother. And then, of course, let's remember that this is supposed to be a La Nina year, and maybe that also would be a positive in terms of food prices and output. Suyash, now to the monetary policy. What would the RBI do in a context of uncertainty about the budget?
So, Latha, I think it is a steady as it goes kind of policy. RBI doesn't need to do anything at all. Their focus since late last year has been more active liquidity management, which is different from how this entire rate hike cycle was conducted. So you'll recall that the move from 335 on the overnight rate effectively to 6.5, going up to 675 later on. But most of this was conducted in a period of heavily excess liquidity. And the liquidity framework has always been about, since 2020, that you have to target weighted average overnight rate using variable rate auctions, not really focus on quantum of excess liquidity. Our sense is, RBI may have been worried about pockets of excessive credit growth, and therefore they wanted to ensure bigger transmission of historic rate hikes via more actively channeling liquidity. Now, one has to see going forward, you are seeing distinct signs of unsecured credit growth slowing, loans to NBFC from banks slowing, and whether that starts to give some comfort to RBI to let loose a bit on active liquidity management, in a sense that if the excess core liquidity translates going forward to headline liquidity going up via government spending, how proactive the RBI is going to be to absorb that excess.
Okay.
Our guess is in the first phase, they would continue to be, but as time passes, probably towards the end of the year, RBI will also be slightly more relaxed on liquidity. But for this policy, there's really nothing much we can see that they need to do.
Okay, just the one word on policy from you, Abhishek. Overall, will they leave you with a dovish tilt or a hawkish tilt?
It will be neutral, as Suyash pointed out. We don't expect any change in key policy settings or in macro projections. They should have that risk management mindset, given that there is still a little bit of uncertainty about how fiscal policy will evolve. They should use these arguments on the monsoon front, on the global Fed policy front, and now, I mean, these fiscal dynamics, which they will not point out, but all this to indicate a steady policy. Maybe August or October policy meetings could be more relevant to more closely evaluate any need for shift in policy communication and settings.
The more important number we want from you is the guess on the 10-year, because the equity markets really ran up the PSU basket, because obviously they have a huge amount of stake in bond prices remaining high. Now, PSU banks took a hit. A bit of recovery has come, but not all of it. If you look at the month to date or the week to date performance, PSU bank stocks still remain laggards. So, Suyash, on that, what would your trajectory for the 10-year be for the month, for the quarter?
So, Latha, I'll conveniently sidestep the numeric question, but I will lay out a more general summary philosophy. We think probably India is at the cusp of a structural run in fixed income for a variety of reasons, including improving macro, the scale of India, the bond index inclusion, and US macro policy, which is probably leading to long-term dollar re-rating or de-rating. And we think, the next 2 to 3 to 4 years, India is probably a structural market. In the very near term, there is some sign that US consumption weakness is beginning to show through. If the Fed were to start to signal a change to the cycle, then, bond yields here will also start to drop more meaningfully. But we are reasonably convinced that over the next 2, 3, 4 years, we are looking at a bit of a structural market in India fixed income.
Okay, and this is despite the political setup?
Yes, because we are assuming still broad macro policy continuity, which we are happy to continue to assume.
Yeah, I mean, of course, there is Sachs buoyancy. There are other reasons, I agree with you. And a long-term inflation targeting also now part of the DNA of the policy. Abhishek, your thoughts? I mean, we also want a near term. It's very good to hear that India is probably in a medium term or a longer term bond bull market. But for the near term, for the month, for the quarter, because it so determines the PSU's banking stocks, how would you look at the 10-year yield trajectory?
Assuming fiscal deficit, is close to RE in the upcoming final budget. And our assumption is there are no rate cuts that are likely in the current CY, although markets could try to price in that, especially if global developments are also favorable. So in that light, we think 690, 710 kind of range should continue to play out. Earlier we saw bond yields trading in the 720 kind of a range. But now, assuming there is still some likelihood that rated borrowing program, there's still some probability it could come down. So given these expectations, we think maybe 690, 710 kind of range could still hold.
For the quarter, you mean?
Yes.
Okay. Well, gentlemen, thank you very much for giving us a picture of what to expect from the Reserve Bank and more importantly, how to approach the bond market. Just a final quick question. I just want a numerical yes-no, numerical or yes-no from you. Any changes to the growth or inflation forecast, Suyash?
No.
Earlier, we were expecting an upward thrust actually to the 7% GDP forecast. Anything RBI will tinker?
Probably too early, no.
No. Abhishek?
No.
No, 7% GDP and 4.5 CPI would perhaps remain. And with a bit of luck, we did have one shower in Mumbai. If the rains are munificent, bountiful by August, perhaps we could have some readjustment lower on the inflation forecast, but there is time for that. Thank you very much, Abhishek and Suyash, for joining me. We will know, of course, what the RBI is thinking exactly 24 hours from now. 10:30 tomorrow, we should know what the Reserve Bank has decided. We wrap up on Bazaar on that note, and Chartbusters will take the action forward. And it's a very, very buoyant stock market. 1% higher on the big indexes, 2.5% on the mid caps.